How does hard money work? And what is hard money? Most loans require proof that you can repay them. A hard money loan is a short-term loan that is funded by private investors as opposed to conventional lenders like your bank. These investors loan money based on the property that you're buying and its value, not your credit score. If you can't repay the loan in the allotted time, hard money lenders can foreclose just like a bank to take over the property and sell it. Now here are some facts about hard money. You can usually borrow for 5 months. A longer time frame will cost you more. If you want to keep the house, you should refinance as soon as possible, and there are 2 types of refinance: rate and term or cash out refinance. Rate and term is where you're just paying off the existing mortgage on that property. Cash out refinance is where you refinance the property and get extra cash over and above the mortgage payoff. This is possible right away. However, if you want to use the current value of your home, you would need to wait 6 months from the purchase date. The hard money loan can be written for 100% of the purchase amount, but a deposit is still required. It typically costs 2 to 4 points to set up the loan, which is also called origination fee. 1 point equals 1% of the total loan amount. Now these fees can typically be rolled into your loan at the end. It doesn't have to come out of your pocket. Here are some pros to hard money. There are fewer qualifications compared to more typical loans. You may be able to get the funds in 7 to 14 days. You're dealing with one person versus a committee, and properties that may not qualify for a loan can be purchased and at a faster rate. Here are some cons to hard money. It is more expensive. Interest rates range from 9 to 12% per year. Most hard money lenders do not finance owner-occupied properties, and it usually requires 50 to 20% down. Now here's when it might make sense for you. If you need a short-term loan, if you want to compete with cash buyers, if you know you can buy a property and flip it for a huge profit and you can't get a regular mortgage, if a buyer has credit issues, when an investor needs to act quickly, or when using the BRRRR strategy: buy, renovate, rent, refinance, and repeat. Now here's an example for you. A $250,000 property that you want to buy. You need to put 20% down, which is $50,000. $200,000 in hard money will be borrowed. There is a $4,000 origination fee. $204,000 is your loan total. 12% of total loan amount is $24,480. Divide that by 12 months, which means you have $2,040 a month in just interest, and that covers the cost of funds to borrow. Do you think hard money might be what you need? Reach out today. We can definitely help you.